Right now, at this very moment, millions of retirees and immigrants across the United States are going about their daily lives completely unaware of a new IRS rule that could directly and significantly impact their tax return this season. For some, it will mean an unexpected tax bill they never saw coming. For others, it will mean penalties for forms they did not even know they were supposed to file. And for thousands of immigrant families and fixed income retirees, it could mean delays in receiving refunds they are counting on to pay rent, buy groceries, and cover medical bills. The 2026 tax season is unlike anything that has come before it, and the window to prepare is closing faster than most people realize. If you are a retiree living on Social Security and retirement savings, or an immigrant who has worked hard and built a life in this country, what we are about to share with you could save you hundreds or even thousands of dollars, but only if you act on it before it is too late. Welcome to U.S. Immigration Intel, your most trusted and comprehensive source for immigration news, IRS updates, Social Security information, retirement guidance, and everything that affects the financial lives of retirees and immigrants living in the United States of America. Today, we are dedicating this entire video to one of the most urgent, most widely misunderstood, and most consequential topics of this entire tax season. The new IRS rule that is already causing confusion, anxiety, and in some cases real and serious financial harm to some of the hardest working and most vulnerable communities across this nation. We are going to break down exactly what this rule is, where it came from, who it affects, how severe the consequences can be for those who are unprepared, and most importantly, the specific steps you need to take right now, today, to protect yourself, your income, and your family from the risks of this tax season. To fully understand why this new IRS rule carries such serious implications for retirees and immigrants specifically, we need to step back and look at the broader landscape of tax enforcement and policy changes that have been building over the past several years in the United States. The Internal Revenue Service has undergone a dramatic transformation in terms of its funding, its technology, and its enforcement priorities. Following years of budget cuts that left the agency understaffed and underfunded, Congress authorized a significant influx of new resources for the IRS with the explicit goal of improving tax compliance across a broader range of taxpayers and closing what economists call the tax gap, the difference between taxes owed and taxes actually collected. This influx of resources has translated directly into upgraded data systems, expanded audit capabilities, new reporting requirements, and a sharper focus on categories of taxpayers whose compliance has historically been difficult to verify. For most wage-earning Americans with straightforward employment income, a W-2, and perhaps a mortgage deduction, these changes may pass largely unnoticed. The IRS systems are already well-equipped to verify this type of income and ensure compliance. But for retirees drawing from multiple income sources, Social Security, IRA, 401k accounts, pensions, annuities, investment income, and part-time work, the picture is far more complex. And for immigrants, navigating the intersection of United States tax law with the tax systems and financial accounts of their home countries, the complexity is even greater. It is precisely these two groups, retirees and immigrants, who are most exposed to the risks created by the new IRS developments of 2026. And it is precisely these two groups that U.S. Immigration Intel is committed to protecting through clear, accurate, and timely information. Let us begin with the changes that are most directly affecting retirees this tax season. One of the most significant and least understood issues is the taxation of Social Security benefits. A surprising number of retirees, including many who have been collecting Social Security for years, do not fully understand that their benefits can be subject to federal income tax and that the rules governing this taxation have effectively become more burdensome over time, simply because the income thresholds that trigger it have never been adjusted for inflation. These thresholds were set decades ago and remain fixed today, which means that as Social Security payments have increased with cost of living adjustments and as retirees have accumulated more retirement savings, more and more seniors have been pushed above the thresholds without any real increase in their standard of living. Here is how it works. The IRS calculates what is called combined income, which is the sum of your adjusted gross income, any non-taxable interest you receive, and half of your Social Security benefits. If you are a single filer and your combined income falls between $25,000 and $34,000, up to 50% of your Social Security benefits may be subject to federal income tax. If your combined income exceeds $34,000 as a single filer, up to 85% of your Social Security benefits can be taxed. For married couples filing jointly, the thresholds are $32,000 and $44,000, respectively. Given that these thresholds have not changed since they were first introduced, and given that the average Social Security benefit has increased significantly over the years, an ever-growing share of retirees is now subject to taxation on benefits they may have assumed would be entirely tax-free. The IRS is applying heightened scrutiny to how retirees report their combined income in 2026, and errors or omissions in this area are increasingly likely to trigger notices, audits, and demands for additional payment. Closely connected to this issue is the matter of required minimum distributions. The IRS requires that anyone who holds a traditional IRA, a 401k, a 403b, or most other tax-deferred retirement accounts must begin taking minimum withdrawals from those accounts once they reach the age of 73. These withdrawals, known as required minimum distributions or RMDs, are treated as ordinary taxable income in the year they are taken. The amount of each RMD is calculated by dividing the account balance at the end of the previous year by a life expectancy factor provided in IRS tables. Because these distributions are counted as income, they can push a retiree's combined income above the thresholds for Social Security taxation, above the thresholds for certain deductions and credits, and in some cases, into a higher tax bracket altogether. The IRS updated its life expectancy tables in recent years, which has the effect of slightly reducing the required minimum withdrawal amount for most retirees. While this is a modest relief, it does not eliminate the fundamental challenge of managing the tax impact of RMDs, particularly for retirees who have accumulated significant savings in tax-deferred accounts over a long working career. Failure to take the correct RMD amount by the applicable deadline can result in a penalty of 25% of the amount that should have been withdrawn, a penalty that can add up to a very significant sum for retirees with large account balances. The IRS has indicated that RMD compliance will be an area of increased focus in 2026, and retirees who are uncertain about their obligations in this area should seek professional guidance without delay. There is also a growing issue around Roth conversions and the tax planning strategies that retirees use to manage their long-term tax burden. Converting funds from a traditional IRA to a Roth IRA can be a powerful strategy for reducing future RMDs and creating tax-free income in later retirement years. However, Roth conversions generate taxable income in the year of the conversion, and if not carefully managed, they can have unintended consequences, including triggering higher Medicare premiums through the Income-Related Monthly Adjustment Amount, or IRMAA, which increases Medicare Part B and Part D premiums for beneficiaries whose income exceeds certain thresholds. The interaction between Roth conversions, RMDs, Social Security taxation, and Medicare premiums creates a complex web of considerations that requires careful planning and a thorough understanding of the current rules. Now, let us turn to the issues that are most pressing for immigrant communities across the United States in this tax season. The first and most critical point to understand is that virtually every immigrant who is considered a United States tax resident, including all green card holders and anyone who meets the substantial presence test based on the number of days spent in the country, is required to report their worldwide income to the IRS. This means income earned not just in the United States, but anywhere in the world, including wages from foreign employers, rental income from property in another country, interest and dividends from foreign bank accounts, and income from foreign businesses or investments. The United States is one of very few countries in the world that taxes its residents on their global income, and many immigrants are genuinely surprised to discover this obligation when they first learn of it. Alongside the reporting of foreign income, there are two separate but related reporting requirements that apply to immigrants and other U.S. tax residents who hold financial accounts outside the United States. The first is the Foreign Bank Account Report, or FBAR, which must be filed with the Financial Crimes Enforcement Network, a bureau of the United States Treasury Department, by April 15th of each year, with an automatic extension available until October 15th. The FBAR is required for any U.S. tax resident who had a financial interest in or signature authority over one or more foreign financial accounts if the aggregate value of those accounts exceeded $10,000 at any point during the calendar year. It is important to note that this is not a tax form. It is a disclosure form, and it is filed separately from your federal income tax return. The second reporting requirement is FATCA, the Foreign Account Tax Compliance Act, which requires U.S. tax residents to report specified foreign financial assets if the total value exceeds certain thresholds. These thresholds vary depending on whether you are filing as a single individual or as a married couple, and whether you live inside or outside the United States. FATCA reporting is done on Form 8938, which is attached to your regular federal income tax return. The penalties for failing to file Form 8938 when required begin at $10,000 and can increase to $50,000 for continued failure after IRS notification. These are not small amounts, and they can apply even when the underlying income from the foreign accounts has been properly reported and taxed. The IRS has dramatically increased its ability to identify non-compliant foreign account holders through its agreements with foreign financial institutions and foreign governments, which are now required to report information about U.S. account holders directly to the IRS. This means that the days when unreported foreign accounts could go undetected are largely over. Immigrants who have not previously been compliant with FBAR and FATCA reporting requirements should seriously consider coming into compliance through one of the IRS's streamlined filing procedures, which are designed to allow non-willful non-compliance to be corrected with reduced penalties. However, this option is only available to those who come forward voluntarily before the IRS contacts them, which makes acting sooner rather than later critically important. For immigrants who use individual taxpayer identification numbers, ITINs, rather than Social Security numbers, the ITIN expiration issue remains a serious and ongoing problem. ITINs that have not appeared on a federal tax return for 3 consecutive years automatically expire and must be renewed before they can be used to file a valid return. The renewal process requires submitting Form W-7 along with documentation, proving foreign status and identity, and processing times can stretch to several weeks or even months during peak periods. Filing a tax return with an expired ITIN can result in the return being rejected or processed with significant delays, which directly affects when refunds are issued for immigrant families who are counting on their tax refund to meet important financial obligations. This delay can be extremely stressful and financially damaging. It is also worth addressing the situation of immigrants who are in mixed status households, families where some members are U.S. citizens or permanent residents, and others are undocumented or hold temporary status. Tax filing in these households is particularly complex, and the fear of immigration consequences can sometimes cause family members to avoid filing altogether. This is a serious mistake that can make the situation worse rather than better. Filing taxes is generally considered a positive demonstration of good moral character in immigration proceedings, and failing to file when required can create legal and immigration complications down the road. There are tax preparers and organizations that specialize in helping mixed status families navigate their filing obligations safely and correctly, and seeking their assistance is strongly recommended. Both retirees and immigrants should be aware that free and low-cost tax assistance is available throughout the United States. The IRS Volunteer Income Tax Assistance Program, VITA, provides free tax preparation to taxpayers earning generally $60,000 or less to people with disabilities and to those with limited English proficiency. The Tax Counseling for the Elderly Program, TCE, provides specialized free assistance to taxpayers aged 60 and older with particular expertise in pension and retirement income issues. Both programs use IRS-certified volunteers and are available at thousands of community locations, including libraries, community centers, churches, and senior centers. For immigrant communities, organizations like the National Immigration Law Center and various local legal aid societies also provide guidance on tax obligations and can connect families with appropriate professional resources. The single most powerful thing you can do right now to protect yourself during the 2026 tax season is to get informed and get organized. Gather all of your income documents. Understand what forms you are required to file. Verify that your ITIN is current if you use one. Check whether you have foreign accounts that trigger FBAR or FATCA reporting. Review your Social Security income and understand how it will be taxed. Confirm that you have taken your required minimum distribution if applicable, and if you have any doubt about any aspect of your tax situation. Consult a qualified tax professional before you file. The cost of professional advice is almost always far less than the cost of penalties, interest, and stress that come from errors and omissions on a tax return. The 2026 tax season is a pivotal moment for retirees and immigrants across this country. The rules have changed, the enforcement has intensified, and the consequences of being unprepared are more serious than ever before. But with the right information and the right preparation, you can navigate this season successfully and protect every dollar you have earned and every benefit you deserve. Thank you so much for watching U.S. Immigration Intel today. If this video gave you information that you needed and that you might not have found anywhere else, please give it a thumbs up and share it widely with friends, family members, neighbors, and anyone in your community who could benefit from knowing what we covered today. Subscribe to U.S. Immigration Intel right now so that you never miss a critical update about immigration, taxes, Social Security, retirement benefits, and all the news that matters most to retirees and immigrants living in the United States. At U.S. Immigration Intel, our commitment is simple: to keep you informed, to keep you protected, and to make sure that no matter how complex the rules become, you always have the knowledge you need to move forward with confidence.